Warren Buffett once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." Let's say you were the one who planted that seed. Years ago, you bought a stock. Maybe you received stock options. Maybe it was an early investment. Maybe it was simply a company you believed in. Over time, that seed grew into a massive tree. That's a great thing. But now the tree takes up most of your backyard, and what if it falls? This is the risk in holding a concentrated stock position. A large portion of your wealth is tied to one company, one stock, and one set of risks. You know you should trim it back and diversify, but there's one big problem: taxes. If you sell, that's a huge tax bill. One common solution is direct indexing. Instead of owning a fund, you own a diversified basket of individual stocks. Some of those stocks will rise, some will fall. When certain stocks decline, you can sell them, realize the loss, and replace them with similar investments to maintain market exposure. Those harvested losses can then help offset gains. Helpful? Absolutely. But sometimes it's not enough. If you have a very large gain, a traditional long-only direct indexing strategy may not generate enough losses to make a dent in your tax burden. In other words, you may not be able to sell enough trees before the huge tree becomes a bigger problem. This is where tax-aware long-short strategies can help. It takes the idea of direct indexing to another level. Imagine investing $1 million into a diversified stock portfolio. You then borrow and sell short roughly $300,000 of stocks expected to underperform the market and use those proceeds to buy an additional $300,000 of stocks expected to outperform the market. This is a classic 130-30 portfolio, 130% long and 30% short. The portfolio still behaves broadly like the stock market, but now you have greater potential for outperformance and greater potential for tax losses. Why does that matter? A traditional portfolio can only harvest losses from the stocks it's long. A tax-aware long-short portfolio gives you more market exposure for the same upfront capital, plus the opportunity to harvest more losses from the additional long and short positions. Long-short investing is nothing new. The difference is this tax-aware version is grounded in tight risk control rather than speculation like a hedge fund. This is a wonderful breakthrough in the wealth management space. However, long-short portfolios are not right for everyone. This is a solution mainly for investors staring down a big capital gains tax bill, such as business owners selling a company, employees exercising stock options, investors with concentrated stock positions, or investors in high-performing portfolios. For these investors, creating more losses to help offset gains can make a real difference. Think of it this way: direct indexing gives you pruning shears. Tax-aware long-short gives you an entire fleet of tree trimmers. Because planting the tree was only half the battle. Managing it wisely is what lets you enjoy the shade and not the fall.